Hello and welcome to Earnings Echo. We put together the most important information about Spotify. Imagine delivering a record-breaking quarter, absolutely crushing Wall Street's profit forecasts, and your reward is watching your stock plunge almost 12% in a single day. That is exactly what just happened.
Yeah, it's wild. So looking at the Q1 2026 hard facts, total revenue hit 4.53 billion euros, which was a slight miss against the 4.62 billion consensus.
Well, the bottom line was incredibly strong.
Oh, absolutely. Diluted EPS reached 3.45 euros, and operating income hit a record 715 million euros, easily clearing the 660 million forecast.
So they crushed operating profit, yet the market reacted brutally. The stock plummeted to roughly 379 euros. If the bottom line is breaking records like that, why the massive sell-off?
It really comes down to a collision of three factors. First, that top-line revenue mis-spooked investors. Second, we saw distinct weakness in the ad-supported segment.
And a third factor.
Just pure sell-on-the-news profit-taking. The stock had a massive run-up right before earnings, so perfection was already priced in across every single metric.
But if premium is booming and margins are up, where exactly is the bleeding coming from? It can't just be a blanket revenue miss.
No, the drag is entirely localized in the ad-supported tier. Revenue there declined 5%, driven directly by, pricing softness in music advertising.
Premium is a completely different story, though.
Right. Revenue jumped 10% there. That was fueled by a 5.7% increase in average revenue per user, with the subscriber base hitting 293 million.
I like to think of Spotify kind of like a giant nightclub. The free ad-supported line around the block is getting a little thinner, but the VIP section inside, the premium subscribers, is not only packed, but everyone is paying a higher cover charge.
Exactly. And that VIP section is driving gross margins up to 33.0%, showing real pricing power as premium growth outpaces royalty costs.
Let's scrutinize that record 715 million operating profit, though, because I see a 49 million euro favorability here tied to social charges. Wait, how does a fluctuating stock price artificially inflate their operating profit on paper?
Well, it's an accounting mechanism tied to employee compensation. Many European companies pay payroll taxes on employee stock options.
Oh, so it shifts with the stock.
Yeah, when Spotify's share price drops, the anticipated tax liability on those options decreases. So a chunk of that profit beat is actually a byproduct of the share price falling, not pure operational leverage.
Okay, so record profits in Q1, but then management turns around on a call and guides for lower operating income, down to 630 million euros in Q2. Why take the foot off the gas now?
Management framed this Q2 margin compression as a deliberate reinvestment phase. They are aggressively allocating capital into new AI tools, specifically features like Song DNA, along with targeted marketing.
Did they address the ad revenue drop?
They did, yeah. They strongly projected that ad revenue will recover in the second half of 2026 as their automated sales channels scale up.
If you run a reverse discounted cash flow analysis on this post-drop valuation, the numbers look completely disjointed. I know it isn't a perfect science, but it reveals what future growth the market expects right now. Let's look at the math.
Sure. So at the post-drop enterprise value of roughly 70 billion euros, stacked against a 3.2 billion euro trailing free cash flow, the implied growth rate contracts to a meager 4.5 to 5%.
Pricing Spotify at that kind of growth rate essentially values the company at cost. It gives them zero credit for this massive profitability transformation, the double-digit revenue growth in premium, or the widening AI moat they're building.
Exactly. The core echo for investors today is this. Spotify's free cash flow engine is expanding at an unprecedented rate, shifting from cash neutral in 2022 to 3.2 billion trailing today.
Yet the market severely punished a minor ad revenue miss simply because re-earnings expectations were so inflated.
Right, exactly.
Leaving you with a final provocative thought is the market's hyper-focus on a temporary 5% ad pricing dip, blinding it to the structural cash generation explosion happening right now in the premium segment.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.